Welcome to this comprehensive guide on how to interpret Wealthfront investing. Wealthfront is a popular robo-advisor that offers low-cost and diversified investment portfolios. To get started, it is essential to understand the key concepts and terminology used by Wealthfront. First, you need to understand the concept of risk parity, which is the foundation of Wealthfront's investment approach. Risk parity is a method of allocating assets in a portfolio to balance the risk of each asset class. Wealthfront uses a combination of low-cost index funds to create a diversified portfolio that is tailored to your individual risk tolerance and investment goals. When you sign up for Wealthfront, you will be asked to complete a risk assessment questionnaire. This questionnaire will help Wealthfront determine your risk tolerance and investment goals. Based on your responses, Wealthfront will assign you a risk score, which will determine the asset allocation of your portfolio. The asset allocation is divided into several categories, including U.S. stocks, international stocks, real estate, and bonds. The allocation of each category is based on your risk score and investment goals. For example, if you have a low risk tolerance, your portfolio will be allocated more towards bonds and less towards stocks. Wealthfront also offers tax loss harvesting, which is a strategy that helps to minimize tax liabilities by selling securities that have declined in value and using the losses to offset gains from other securities. This can help to reduce your tax bill and increase your after-tax returns. To interpret your Wealthfront portfolio, you need to understand the performance metrics used by the platform. Wealthfront provides several metrics, including return, volatility, and Sharpe ratio. The return metric shows the total return of your portfolio over a given period. The volatility metric shows the standard deviation of your portfolio, which is a measure of risk. The Sharpe ratio metric shows the excess return of your portfolio over the risk-free rate relative to its volatility. In terms of best practices, it is essential to monitor your portfolio regularly and rebalance it as needed. Rebalancing involves selling securities that have increased in value and buying securities that have decreased in value to maintain the target asset allocation. It is also essential to take a long-term view and avoid making emotional decisions based on short-term market fluctuations. In conclusion, interpreting Wealthfront investing requires an understanding of key concepts, such as risk parity, asset allocation, and performance metrics. By following the steps outlined in this guide and using the best practices, you can make informed investment decisions and achieve your long-term financial goals. Wealthfront's low-cost and diversified investment portfolios, combined with its tax-efficient strategies, make it a popular choice for investors who want to grow their wealth over time.